Good morning. Welcome to Core Services and our Core Belief Series, Why It Matters. Today we're going to be discussing the Audit Committee and the internal audit and how it can benefit both for-profit and non-profit organizations. I'm John Coggle and I'm the presenter for today's episode. So as we get started, a little bit about Core Services. Core is focused on audit and review services primarily for condos and HOAs in Oregon and Washington. And we also offer advisory services, and we are now experimenting with offering internal audit services for nonprofits especially. But we do board meeting observations to help ensure that the meetings are efficient and effective. We also do vote supervisions, especially in condominiums where it might be a contentious vote issue and you want to make sure you have an independent observer to the count. And any other services that can benefit a board of directors in ensuring that their organizations complies with policies. So today what we're going to talk about is, again, the audit committee and the internal audit. And that really comes from the fact that we actually just got through with a biannual, the first of our biannual internal audit evaluations of a client, where we went through, looked at all the transactions that occurred, and ensured that they complied with the policies that were put in place. And if the policy doesn't exist, good business practice. And if it was questionable, we could then fall back on the bylaws, which said exactly what the organization expected from a certain types of transactions. And so, we then presented that to the board. We, answered the questions the board had. I felt it was very successful. The board can then move on without having to worry about the fact that maybe something is spiraling out of control and they're unaware of it. But it does bring up the question, how should you be structured for this? And what you really want in any organization that has a board of directors is probably an audit committee. And the audit committee exists for two purposes. Number one, it's designed to interview and select and manage the relationship with the independent auditor. You don't need to burden the entire board with it. It could be a select committee that handles that, but that's their primary role. They should also review the financial statements, both monthly, quarterly, whenever they're going to be issued, and the annual one, to make sure that they make sense, that they're presented fairly and materially correct, and they're going to answer the questions from the independent auditor if they were to arise. They're also charged with reviewing transactions for policy compliance. It's an important part of this. If we start getting into transactions that maybe could be questionable as to whether they're a revenue item, for instance, having that committee who's independent of management, who really doesn't have a dog in the fight of profits per se, helps to make sure that what's happening is legitimate. And obviously, that committee wouldn't, because their board members wouldn't necessarily do the work. They'd have to have their own team of professionals whose job it is to go out and do that. And if you think about it, it's really all about safeguarding organizational assets and the reputation of the organization. The last thing you really want is to have to recall your financial statements because a mistake was made 3 years earlier that probably should have been caught. Quickly, membership should be independent, non-employee, non-management, especially board members. And everyone should have to be aware of the fact they should not have a conflict of interest as it pertains to the selection of an independent auditor. In short, if you're sitting on the audit committee, you do not want to be pushing your CPA to be doing the audit for your organization. And really, it's a missed opportunity. The audit committee, if it's doing its job effectively along with its internal audit team, can identify problems sooner. And again, that auditor might only come in really once or twice a year to examine the numbers, do some tests. They may not catch it soon enough. And again, problems snowball and they become larger as time goes along. So by looking at it more frequently, asking questions, you can identify the things got out of control. And because you've identified it quicker, you can get corrections in place faster. So what is the internal audit? Well, so we look at it as it's compliance with policy and process. When you're writing a check, are all the appropriate initials on the supporting documents to verify that the treasurer should sign the check to send the payment out? Are transactions being recorded accurately? Are they going to the right budget classifications. This is very important for nonprofits. There again, there's nothing worse than waiting until March or April or June of the following year to find out that transactions have been recorded incorrectly. You've issued them to the bank, you've issued them to other stakeholders. Then you have to explain to people at the end of the year why the numbers they were looking at aren't right. Not a great thing. Another thing they could look for is the missed opportunities, the opportunity cost. One of the things we identified during our examination is there was an authorization to move money to an investment fund, and this happened in February. Well, by the end of July, it still hadn't been transferred. Lots of reasons why. This isn't about pointing blame. It's the fact that the authorization was given and 4 months later transactions still hadn't occurred. And so there's that opportunity cost. They lost investment earnings on that money because it was still sitting in their checking account. So it's looking for those types of things. Are we doing things to maximize the organization's opportunities? And really, you're looking for both potential conflicts and the opportunity to weigh in on vague policies to ensure that they're being interpreted correctly. And ideally, the internal audit reports to the audit committee, but it could also report to the treasurer. And in our case, we report directly to the board of directors. The question obviously there is making sure there's a clear chain of responsibility between the internal audit team and a board. The management group should not be part of that chain. So obviously, why it matters. Both the internal and external audit are extremely important. Obviously, we focus a lot on the independent external audit, financial statement audit, but having that internal audit can give the board and everyone else involved as a huge peace of mind. Reliance. Think about it. When I as an external auditor, and we go in and do some of these audits, we can't rely upon what management tells us because there's nobody checking to make sure that management complies other than management's word. So if there was an independent party that we could discuss this with, are they doing this, are they doing that, and we could review their reports, we could begin to rely upon their process and perhaps cut back some of our detailed work because somebody else has already looked at it. It's never going to be required of us, but where we feel confident in it, we can rely upon that, which might save 20-30% of the time that goes into an audit. Both are really designed to give actionable information to the board. The internal audit, obviously more timely. The external financial statement audit is really all about that financial statements being correct, which is after the financial statements of all the transactions for the period have been entered, and you've had a little bit of time in between to make sure liabilities are all recorded. There's nothing unrecorded out there. But both can provide the board good, solid information to make decisions, which is the goal of any type of work that's being performed. And again, going back to that, this is why management should not be involved. The more separation there is between management and the reports that are being issued, the greater reliance that the board has that things are okay. If I have no stake in management, management has no control over my work as an independent auditor, the board can rely upon the fact that what I say is probably true. Management may not like it, but that's just the way it is. Same thing with that internal audit. If they give the report and it holds management accountable and management doesn't necessarily like it, that's probably a good thing. Management's should not have a whole lot to say. They might be able to say, yes, we agree, but it would cost $1 gazillion to implement. Okay, that's their take on it, and that's what the audit committee would need to evaluate the cost benefit. But the reality is that report gives the board good information to go back to management and say, is this even feasible? And that's really what you're looking for. So I hope this has been helpful to you regarding internal audit and the independent audit. As always, you can find us on the web at core-acct.com. You're more than welcome to fill out a contact form, send us any questions you may have. Contact us on Twitter and on LinkedIn. I hope you have a great day. We look forward to our next presentation with you.